During the 2008 financial collapse, while major banks were disintegrating and retirement accounts were losing half their value in real time, one category of investment quietly posted a 25% gain. Not a hedge fund, not some billionaire's private deal, a publicly available asset class that anyone with a brokerage account could have owned. Most people had never heard of it. Most still haven't. And that single fact, that specific, documented anomaly from one of the worst financial disasters in modern history, is the thread we're going to pull tonight. Because when you follow where the money actually went during every major crash since 1929, a pattern emerges. Dark, quiet, almost invisible. The same assets keep surviving. The same assets keep growing. And yet this pattern rarely makes it to the center of mainstream financial coverage, which means most investors never see it laid out this clearly against the full sweep of the historical record. By the end of this, you'll know exactly what those assets are, and you'll know the one specific move you can make this week, not someday this week, to start positioning yourself before the next wave hits. Let's follow the evidence. First, gold. This is where most people think they already know the story. Gold goes up in a crisis. Simple. But the documented reality is far stranger than that. During the Great Depression, while the Dow Jones Industrial Average lost the vast majority of its value between 1929 and 1932, historical records from that period put peak-to-trough losses at close to 90% the price of gold, fixed at the time by the U.S. government, held completely steady. Then in 1934, Franklin D. Roosevelt revalued gold upward by roughly 69% with a single piece of legislation, the Gold Reserve Act of 1934, resetting the official price from around $20 per ounce to $35 per ounce overnight. A single executive order. People who held gold didn't just survive the Depression, they came out ahead of it. That detail changes everything, because it tells you gold isn't just a panic asset, it's a structural asset. Governments reach for it when the system itself is broken. During the stagflation crisis of the 1970s, gold surged from roughly $35 per ounce at the decade's start to a peak of around $850 per ounce by January 1980, a gain of more than 2,000% in under 10 years, according to historical price records tracked by the World Gold Council. During the 2008 collapse, it rose more than 25% while equities hemorrhaged. The pattern is not a coincidence, it is a feature. Second, consumer staples. People stop buying cars in a recession, they stop booking vacations, they stop upgrading their phones, but they do not stop buying toothpaste, they do not stop buying soup, they do not stop buying cleaning supplies. This sounds obvious. What's not obvious is how dramatically this insulates certain companies from economic destruction. During the 2008 crash, the S&P 500 fell roughly 57% from peak to trough. Consumer staples stocks, companies like Procter and Gamble and Colgate-Palmolive, significantly outperformed the broader market during the 2008 crash, declining well below the S&P 500's roughly 57% peak-to-trough loss and recovering faster, according to sector performance research from Morningstar. Across the major recessions since World War II, the consumer staples sector has consistently outperformed the broader market, a pattern documented across multiple economic cycles in sector performance research. And this is the part nobody talks about. Those companies don't just survive, many of them pay dividends, consistent quarterly cash payments, even through the worst downturns. Procter and Gamble has increased its dividend every single year for more than 6 consecutive decades, according to the company's own dividend history published through its investor relations page, a streak that has survived recessions, wars, and global pandemics without interruption, through recessions, through wars, through global pandemics, unbroken. Third, Treasury bonds. When investors panic, and they always panic, money floods out of risk assets and into you. This is so consistent it has a name, the flight to safety. During 2008, while equity markets collapsed, long-term Treasury bonds delivered substantial positive returns. The iShares 20-plus year Treasury ETF, for example, gained over 25% that year as investors rushed into government debt, a dynamic track through Federal Reserve rate data and ETF performance records. That same number again. That's not coincidence. That's capital in motion, following a pattern it has repeated for over a century. Fourth, discount retail. This one is counterintuitive, deliberately so. When household budgets tighten, consumers don't disappear, they migrate. They move from premium retailers to discount retailers. During the 2008 recession, discount retailers as a category broadly outperformed the market. Consumers under financial pressure migrated from premium stores to value-focused alternatives, driving relative strength across the discount retail sector, even as broader equities fell sharply. During the early pandemic-era economic shock, discount retailers broadly outperformed. The economic pressure that destroys luxury spending literally creates customers for these businesses. Nobody expects what came next in the most recent data cycle. Discount retail as a category has now expanded into food, pharmacy, and financial services. The addressable market keeps growing precisely because economic stress keeps growing. Fifth, real assets with pricing power. Farmland, infrastructure, essential real estate, assets that produce something people need regardless of what the stock market is doing. Farmland values have increased in 47 of the last 50 years according to USDA data. Not every year, but 47 out of 50. Through recessions, through financial crises, through everything, because people eat. That fact is recession-proof by definition. Now, remember what I said at the start, one publicly available asset class that posted a 25% gain during the worst financial crisis in a generation. That was long-term Treasury bonds, documented, verifiable, available to any investor with a standard brokerage account. Here is the one concrete action. Today, this week, open your current investment account and check your allocation across these 5 categories: gold or a gold ETF, consumer staples index funds, treasury bonds or a bond ETF, discount retail exposure, and real asset funds including farmland REITs. If any of these categories sits at 0 in your portfolio, history suggests you may be carrying more concentration risk than you realize, because across the recessions on record, diversification into these categories has consistently provided a buffer that more narrowly positioned portfolios did not have. The question history keeps asking is the same one it's asking right now. When the next wave comes, and every documented cycle says another one will, which side of the pattern do you want to be on? This video is for educational and entertainment purposes only and does not constitute financial, legal, or investment advice. Always do your own research before making any financial decisions.